An introduction to the world's most powerful central bank, the Fed. The Federal Reserve, or the Fed, is the undisputed heavyweight champion of the global financial system. It doesn't control any nation's sovereignty, yet its actions send ripples through every economy. A single policy document can roil stock markets and move currencies. A mere statement can force central banks worldwide to hastily adjust their strategies. This entity at the very top of the global financial food chain is the Federal Reserve System, the Fed. Unlike the orthodox origins of other central banks, the Fed was born from financial chaos. From the late 19th to early 20th century, the U.S. was plagued by banking panics. With no unified central bank as a backstop, bank runs were frequent. The failure of a single bank could trigger a chain reaction, collapsing the entire financial system. The panic of 1907 pushed America to the brink. Core banks and trust companies failed one after another. Liquidity dried up, and stability was only restored by a private bailout fund organized by J.P. Morgan and a consortium of wealthy financiers. This crisis forged a national consensus. Without a powerful central bank, even the strongest economy was vulnerable. In 1910, bankers representing financial titans like Morgan and Rockefeller met secretly with government officials on Jekyll Island, Georgia, to draft the framework for a central bank. After 3 years of political wrangling and compromise, the Federal Reserve Act was signed on December 23, 1913. The Fed was born. It broke the mold of being purely public or private, creating a unique hybrid public-private system with a decentralized structure. 12 regional reserve banks, funded by local member banks, were overseen by a central Federal Reserve Board in Washington. This design balanced national policy with regional needs and held the latent potential for overarching control from its inception. The market meltdown of 1929 triggered the Great Depression. The Fed's initial response was flawed. It allowed the money supply to shrink and banks to fail. Yet, this failure paved the way for its expansion of power. The Glass-Steagall Act of 1933 and the Banking Act of 1935 established federal deposit insurance and shifted power from the regional banks to the central board in Washington, cementing the core governance structure of the modern Fed. The 1951 Treasury-Fed Accord established its status as an independent power. During World War II, the Fed was forced to help the Treasury finance war debt by keeping interest rates artificially low, compromising its independence. Post-war inflation exposed this conflict. The accord freed the Fed from the obligation to peg government debt prices, formally establishing the principle of monetary policy independence. From then on, the Fed was no longer subservient to the government. It made decisions autonomously based on economic data, becoming a veritable financial sovereign state. In 1979, facing runaway inflation near 15%, Fed Chairman Paul Volcker took drastic action. He abandoned targeting interest rates, instead strictly controlling the money supply, pushing the federal funds rate to 20%. He did not waver even as it caused a recession, ultimately taming inflation and cementing the Fed's reputation as an inflation slayer. On Black Monday in 1987, when stocks plunged 22.6%, the Fed under Alan Greenspan promptly promised to provide ample liquidity, calming markets overnight. This created the myth of the Greenspan put, reinforcing global expectations that the Fed would backstop major market risks. The 2008 financial crisis catapulted the Fed's power to its zenith. Facing frozen markets, it not only slashed interest rates to near zero, but also deployed quantitative easing. It purchased bonds on a massive scale, ballooning its balance sheet from under $900 billion to $4.5 trillion, injecting oceans of liquidity. It also expanded its emergency lending, extending its role as lender of last resort to the entire financial system. Though controversial, these actions are credited with preventing a global depression, embedding the Fed's influence into every corner of world finance. Its interest rate policy dictates global capital flows. When it raises rates, capital floods into the U.S. chasing returns, often triggering currency devaluation, capital flight, and even debt crises in emerging markets. When it cuts rates, a torrent of dollars flows outward, inflating asset bubbles worldwide. Today, the Fed has transcended its role as merely the U.S. central bank to become the central pillar of the global financial system. Adjustments to its balance sheet directly dictate the ebb and flow of global liquidity. Shrinking the balance sheet tightens the dollar supply and raises borrowing costs worldwide. Expanding it floods the system with dollars, feeding risky assets. The dollar's reserve currency status grants the Fed a hidden power to, in effect, harvest value globally. When the U.S. faces trouble, the Fed can export risks by printing money and cutting rates, making other nations bear the cost of American economic problems. During the 2020 pandemic, its limitless quantitative easing fueled global inflation. Then, when U.S. inflation soared, its aggressive rate hikes plunged emerging markets into a double bind of currency depreciation and imported inflation. This cycle reinforces its core power position. Looking ahead to 2026, the Fed faces three significant challenges. First, its dual mandate of stable jobs and low inflation is under growing strain. The U.S. labor market appears calm, but is stuck in a fragile balance of low hiring and low firing. Companies, uncertain about the future, are hesitant to expand or to lay off core staff. Tighter immigration policies compound labor shortages, weakening the job market's resilience. Meanwhile, tariff volatility pushes up costs, making inflation stubborn. The Fed is caught in a dilemma. Cutting rates risks reigniting inflation, while high rates threaten to stifle growth. Internal divisions between policy hawks and doves are sharpening, making policy debates more contentious. A second challenge is the risk of erosion to its foundational independence. U.S. election year politics are intensifying. Figures like Donald Trump have publicly pressured the Fed to cut rates and expressed a preference for appointing a dovish chair. Chairman Jerome Powell's term ends in May 2026, marking the first leadership change in 8 years. The new chair will directly set the policy course. While institutional safeguards exist, the creeping influence of political pressure on decision-making is a real concern. The Fed's credibility is the core of its global financial authority. Once damaged, the repercussions would be profound. External shifts are also chipping away at its power base. Artificial intelligence is poised to replace many mid- and low-skill jobs, while new high-skill jobs may be limited and require costly retraining. This could weaken consumer spending power and constrain economic growth, making the Fed's policy job even harder. Simultaneously, a trend of de-dollarization is gaining momentum, with several nations promoting trade in local currencies. This weakens the dollar's dominance and, by extension, reduces the global transmission power of the Fed's policies. Born in turmoil and ascending through crises, the Fed has built a global financial empire over a century. It has been a crucial pillar of global economic stability and, at times, a tool for redistributing wealth. Now, buffeted by internal divisions, political pressures, technological disruption, and a shifting global order, this most powerful central bank stands at a critical juncture. The future boundaries of its power and the trajectory of its influence remain to be seen.